Now, guys, I'm going to show you guys. So everyone has the bullish order blocks, bearish order blocks definition. I've actually broken it down. So I have like my concepts with like the bearish and bullish order blocks, but I also have two specific order block that I kind of renamed. And again, this is not anything new. If you see this around, you'll actually be familiar. Okay, so. All right, guys. So now we're going to get into stop blocks. Now, everyone has this kind of understanding with order blocks and what order blocks are, but I've kind of have two very specific order blocks that I look for, and I'm going to speak about this one right here. So the other one's going to be called a reactionary block, and that's actually going to be in the next lesson. But stop blocks, what are they? Essentially, these are order blocks slash supply and demand levels, again, whatever you guys want to call it, that take out a high or low before making their impulse price push. Now, these add a bit more of a framework with the levels versus just any candle that has a price impulse, right? Because theoretically, you can call any sort of down close candle or up close candles an order block with any significant price run. But having a extra element to it, like taking out a prior high or taking out a prior low, that's a significant piece of information. Now I'm going to go ahead and show you guys some of the concepts which are illustrated in the next slide. So here's a perfect example, right? We have price, very clean liquidity pool here, price highs. You see that price kind of pushes up and we start to have a reaction lower. Now, this is going to be a significant order block because price took out this high and now we had a very strong push down. So typically liquidity is taken. And I know the liquidity section is still going to be, it's still coming up, but you guys can always come back to the videos. I just want to go ahead and talk about all the order blocks that I think are significant. But right here is a good example of how price makes a new high, has a strong push down, and now we have a retest. And you see how this one actually worked very well. Price came down. We had a very significant price drop once price reacted off of this level. And remember the old concepts and I'm going to start to ingrain some of the older concepts that we talked about, right? Price had a push up here, and then we had a significant drop lower. So we know that from this price high to that price low, if price comes up, we know that this lower low is our potential target. And this is something that you guys can use in your trading because okay, if I'm drawing, let's say a Fibonacci from this high down to that low, after we get a very clear stop block and a very clear impulsive push lower, now I can look for a potential area for a retest, knowing that I'm going to look for areas to short in here and potential target down here. Now, not to get ahead of ourselves, but imagine if this is a daily chart. And this is why I always preach about how the time frames don't matter. But because if this is a daily chart, right, this from here down to there, this could be an easy 300 pip move. So you guys can have frameworks that can be at any pip range that you're looking for. This could be a 15-minute chart. So this from here to here could be 15 pips, 20 pips, 30 pips, 100 pips. It doesn't really matter. The time frame, this all applies to any time frame. And this is why I don't include any of the time frames in any of the charts, because it doesn't matter. The concepts are the concepts. So now we know that this area here is possibly going to be next. We don't get it right here, but we get it right there on the next push. And just to kind of reiterate the concept of the 50% mark, especially when you have a big beefy candle like this, sometimes the range is pretty wide. You might just want to use a 50% and usually look for areas. And look at the precision on this example. So here's a bullish example, right? We have liquidity taken. Price has an aggressive drop lower. Price does have some sort of consolidation, and boom, price has a very significant price swing higher. Now, admittedly, in this example, price didn't break any structure to the upside, but because the way liquidity was taken, and we kind of have this kind of V-shaped recovery, we can still look at this consolidation point as a very strong area. And this is an example. I would wait for confirmation, but again, we'll be talking more in depth about that later on. And you guys see right there, price comes in, taps the opening price of that candle, and we are off to the races, and price ends up cleaning house over here. So this is a very simple concept. It's pretty much just an order block that takes out any liquidity pool. And you guys can come back and reference this video once you watched the liquidity pool video, because I'm going to give you guys specific key levels of what I use in my trading in terms of liquidity pools and what I personally look for as really strong reference points.